There is a massive fundamental misunderstanding in how retail investors trade the global shipping sector. Wall Street traditionally treats shipping as a volatile boom-and-bust gamble tied to weekly spot freight rates. But today, we are looking at Danaos Corporation, ticker symbol DAC, and they do not play that game. Danaos operates as a, quote, floating toll booth. They do not operate the cargo. They lease the actual vessels on strictly negotiated, multi-year, fixed-rate charter contracts. Because the market confuses volatile spot rates with locked-in cash flows, this stock has become a massive valuation anomaly, trading at a severe discount to its net asset value. Welcome to StockScope. Let's dive into the maritime arbitrage. To understand the opportunity, we first have to look at the macro environment. The global shipping industry is currently experiencing a massive structural supply shock. The effective closure of the Red Sea and the Suez Canal due to geopolitical disruption has forced the global fleet to reroute around the Cape of Good Hope. This isn't just a minor delay. This rerouting drastically increases ton-mile demand by up to 30% and actively absorbs global vessel capacity. This artificially tightened supply provides a structural floor under the market, driving up the charter rates that Danaos locks in for years to come. This macro backdrop translated into an absolute financial fortress in the fourth quarter of 2025. Danaos reported total operating revenues of $266.2 million for the quarter. This top-line strength was heavily diversified, with $240.6 million generated from their core container vessels and a growing $25.5 million from their dry bulk fleet. But here's the most important metric on this slide. Their voyage expenses were a microscopic $4.2 million. Because they leased the ships out, the charterers pay the operating fuel costs. This means that $266 million in revenue efficiently cascades straight down to pure net income. While retail traders panic over daily freight indexes, the smart money focuses entirely on the contracted revenue backlog. Danaos provides high visibility cash flow because their revenue is legally locked in across multi-year periods. This gives the company fixed income characteristics, completely insulating them from short-term spot market volatility. Furthermore, there is minimal counterparty risk here. Danaos signs these multi-year leases with top-tier, globally systemically important liners like Maersk and MSC. The cash flow is guaranteed by the biggest balance sheets in global logistics. Despite printing massive amounts of predictable cash, the stock is completely mispriced. Danaos trades at a single-digit PE multiple. More importantly, it trades at a severe and irrational discount to its net asset value, or NAV. If Danaos decided to liquidate tomorrow, the hard asset backing, the scrap and secondhand value of their massive steel ships, far exceeds the current share price. For an institutional investor, this severe discount to NAV provides the ultimate margin of safety and downside protection. Management is fully aware of this irrational discount, and they are ruthlessly exploiting it through elite capital allocation. They are using their mountain of free cash flow to execute aggressive share repurchases. Buying back their own stock at a severe discount to NAV instantly shrinks the float and aggressively boosts earnings per share. And while they buy back stock, they are paying you to wait. Danaos offers a highly secured, lucrative quarterly dividend yield. Furthermore, management isn't just resting on their container fleet. They are executing strategic diversification into the dry bulk sector, which contributed over $25 million in Q4 alone. This was a brilliant, counter-cyclical move. Management used the massive cash generated during the container boom to acquire dry bulk assets at the absolute bottom of their respective cycle. This expands their economic moat and stabilizes long-term earnings. To remain objective, let's lay out the bear case, which is driving the retail fear. It comes down to three risks. First, the cyclical cliff. Bears fear that if the Red Sea reopens and new vessel deliveries flood the market in 2026 and 2027, charter rates will crash. Second, macro recession risk. A global consumer slowdown could impact global trade and increase counterparty risk. And third, environmental CapEx. Looming IMO carbon regulations will require costly capital expenditures to upgrade older ships to green standards. But the bull case, the smart money reality, takes the other side. First, the contracted cash flow. That multi-year backlog guarantees massive cash generation through the end of the decade, regardless of near-term spot rate drops. Second, extreme margin of safety. You are buying hard assets at a massive discount to NAV, completely limiting your downside risk. And third, the Red Sea tailwind. The longer this disruption lasts, the more Danaos can lock liners into new, ultra-lucrative multi-year contracts. This sets up the ultimate market blind spot. Retail models suffer from a duration mismatch. They confuse short-term spot freight indices with long-term locked charter rates. This triggers algorithmic mispricing, where quantitative funds sell the stock purely based on weekly spot market dips. The market is pricing Danaos based on 3-month cyclical fears, completely ignoring the fact that the company operates on 3-year guaranteed contracts. Looking at the technical framework on your screen, we see visual confirmation of this thesis. Notice the robust consolidation happening right at our key support zones. Every time algorithms push this stock down, institutional capital steps in to accumulate shares at these steep NAV discount levels. We are identifying these precise support floors as prime entry points for long-term capital allocators who understand the underlying asset value. So what is the stock scope verdict? We are rating Danaos Corporation a, quote, moderate accumulation on a margin of safety. While the shipping sector always carries inherent cyclical macro risks, the guaranteed multi-year backlog and the massive discount to net asset value make this an elite, high-conviction value play. Let the algorithmic traders panic over weekly freight rates. If you can accumulate shares alongside management's buyback program at these support levels, you are setting yourself up for long-term outperformance. Collect the yield, respect the backlog, and make sure you subscribe to StockScope for our next institutional deep dive.